Morning and welcome to the Shenkman Private Client Group Accountant Attorney Fall Webinar Series. This program is entitled State Income Taxation of Trusts. For those who don't know me, my name is Jonathan Shenkman. I'm a financial advisor, portfolio manager, and an accredited investment fiduciary at Oppenheimer based in New York City. The goal of all my programs is to bring professionals together to help them better serve their clients. This is done by educating attendees on the latest topics in wealth planning and by encouraging collaboration between a client's attorney, CPA, and financial advisor where appropriate. My practice focuses on working with high net worth families, businesses, and not-for-profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. I also handle their life, long-term care, and disability insurance needs where applicable. In addition to the 20 to 25 events I run every year, I also do a fair amount of writing on the topics of investing and financial planning. You can read my work in Barron's, CNBC, Forbes, Kiplinger, the Wall Street Journal, the CPA Journal, Trust and Estates Magazine, and many other periodicals. After the program, I'll send out a link to all the publications where I publish my work. Today, we're privileged to hear from Bruce Steiner. Bruce is of counsel at New York-based law firm Kleinberg Kaplan, where he focuses on taxation, estate planning, business succession planning, and estate and trust administration. Bruce has over 40 years of experience and is a frequent lecturer at continuing education programs across the country for bar associations, CPAs, and other professionals. He's a co-author of CCH's Roth IRA Answer Book, a contributing author for Thomson Reuters Revocable Trusts, a commentator for Kleinberg Information Services, a member of the editorial advisory board of Trust and Estates, and a technical advisor for Ed Slott's IRA Advisor. He has written numerous articles for estate planning, B&A tax management, estates and gifts and trust journal, Trust and Estates, Journal of Taxation, CPA Journal, and other professional journals. Bruce has also been quoted extensively in many financial periodicals. Today, Bruce will be speaking on state income taxation of trusts. And with that introduction, I'll now turn the program over to Bruce.
Thank you, Jonathan, both for having me back and also for that wonderful introduction. I'll try to live up to it. We're going to talk today about state income taxation of trusts, which has for a very, very long time been an interest of mine, and I'm happy to see that in recent years, other people seem to be interested in it and starting to pay attention to it. If anything, state income taxation of trusts is more important now than it was before for several reasons. First of all, states have been pushing their tax rates up, I suppose, as the federal rates came down. The federal government pushed more and more expenses to the state level, and so the state taxes went up. New York, if you're in New York City, it goes up to over 14%. If you're in California and it's 5:30 in the morning for you out there, and I thank you for getting up early, your rates go up to over 13%. And there are some other states that have tax rates that are in the 8, 9, 10 range, Minnesota, Oregon, and I'm sure there are others. We can't really talk about all 50 states or the 40 some odd states that have income taxes today, but we'll discuss some of the general concepts, and then we'll focus on some of the larger states, and keep in mind that some of the concepts will repeat themselves in other states. So the thing to keep in mind is that different states have different ways of determining when a trust is taxable. And the example that I would start off with, I guess I used to live in New York and now I live in New Jersey, and Jonathan used to live in New Jersey and now lives in New York. So I, who live in New Jersey, create a trust, and it's its own taxpayer, and Jonathan, who lives in New York, is the trustee, or the other way around. Jonathan, who lives in New York, creates a trust, and I, who live in New Jersey, am the trustee. And if I'm talking to a room full of accountants, I will ask them, well, where does the trust file income tax returns? And they look at me like I'm from Mars, and I say, you're the accountant, you're going to be preparing the returns. What returns are you going to prepare? the correct answer probably is that they should ask the lawyer, but one way or another, somebody's got to go figure it out. And different states have different rules. Some look at where the grantor, the person who created the trust, was domiciled. Some look at where the trustees, or the testator, if it's a trust under the will of a dead person. Some states look at where the trustees are located. Some states look at where the trust is administered. There are other factors. There are exceptions. There are variations. You could easily have a trust that's subject to tax in 2 states. You could easily have a trust that's subject to tax in no state. And for those of you who deal with trusts, I think that having a trust taxable in no state is the best result, and having a trust taxable in 1 state is the middle result, and having a trust that's taxable in 2 states is a poor result. So you should look at it ideally in the planning. You should look at it ahead of time. And if nobody looked at it in the planning, then when it's time to file the returns, somebody should look at it to make sure that you're filing returns and paying taxes in the state or states where you're required to file returns and pay taxes, and that you're not paying taxes in the states where you're not responsible for paying taxes. Because if you do, when you do your accounting, if a beneficiary objects, you may be on the hook for the tax if it's too late to get a refund from the state where you shouldn't have paid it. And I can tell you from experience that asking for a refund because you shouldn't have paid the tax may not be easy. I remember a client changed accountants. They had what was then a Big 8 firm that had done their returns for many years. Then they switched to a very, very tiny, but very, very good firm that had 3 partners, a tax partner, an audit partner, they're 2 young guys, and a senior guy who had some clients that the other 2 could keep busy working on. And the tax partner calls and says, did I want to review the drafts of the federal and the New Jersey 1041s for these trusts? And I had forgotten for the moment that they had New Jersey real estate. And I said, wait a minute, these are Florida trusts. And he said, I don't know, they filed them as New Jersey. The other firm filed them as New Jersey trusts the year before. And I said, did they pay New Jersey tax on that $4 million intangible capital gain? And he said, I don't know. We didn't do last year, but I guess they must have. And I said, would you file a refund claim and file them as non-resident returns? So he did. And they don't just stamp the form and send you a check when you claim a $4 million reduction in your taxable income. Needless to say, it's a reported decision. It went all the way up to the appellate division. That's the intermediate level court in New Jersey. And then where we won, and the state appealed to the New Jersey Supreme Court, which thankfully turned down the case. So these are important situations. So we're going to start with just a few of the states. New York says you're a resident trust if the grantor or the testator was domiciled in New York. But there's a big exception. New York will not tax the trust if there's no trustee in New York, no real or tangible property in New York, and no New York source income of a type on which a non-resident would be taxable, like rental real estate or something like that. And that started off as case law, and then it became regulation, and then it became statute. So if you were created by a resident, but you don't have enough contact with New York calls it an exempt resident trust. You file a return, and there's a page where you sign and you say, I certify that I'm exempt. But even a penny of New York income will taint the entire trust. So if you invest in one of those publicly traded partnerships, and and your K-1 shows you had $3 of New York income, you're taxed on the entire income of the trust. Beginning in 2014, New York enacted a throwback rule, and it says if you accumulated the income in year one and then you distribute it to a New York beneficiary in year two, the beneficiary is taxable on the accumulated income with a credit for the tax that the trust may have paid to other states on that income in prior years. It basically tracks the old federal throwback rule that they used to have until I think in the early to mid 1990s. They finally got rid of it because they realized that at the federal level, the trust rates aren't lower than the beneficiary rates. Indeed, they're generally higher. So the New York throwback rule has lots of exceptions. It's pre-2014 income is exempt and income accumulated before the person became a resident. And like the old federal law, income accumulated before the beneficiary was 21, or capital gains that are not included in DNI. So it's not as strict as it could have been. New Jersey follows New York. New Jersey often follows New York, except for their definition of income, but other stuff, they generally follow the New York rules. The New Jersey court cases cited the New York case, except that New Jersey does not have a throwback rule. I'm surprised they didn't pick it up now that New York has one. Interestingly, the instructions to the New Jersey return say that the same exception applies for New Jersey estates, that if there's no executor in New Jersey, no real or tangible property in New Jersey, and no New Jersey source income, they'll exempt an estate as well. I don't see any support for that in the statute or in the case law, but if they're giving it to you, you might as well take it. Connecticut is a little more complicated. Connecticut's definition of a resident trust is the same as New York's and New Jersey's. Before 1993, they had the same exception for trusts without connection to Connecticut that New York and New Jersey have. Connecticut now taxes a trust if it's a resident testamentary trust under a will, but a trust created during lifetime, they tax it based on the percentage of the non-contingent beneficiaries that are in Connecticut. The Connecticut definition of a non-contingent beneficiary is broader than the California definition, which we'll get to in a couple of minutes, because California is by far the largest state by population, and it tends to set trends for the rest of the country. The Connecticut definition includes sprinklees, discretionary beneficiaries. So if you have a credit shelter trust for the spouse, and if you have a family trust created during lifetime for the spouse and issue or for the issue, you count up how many of those people there are and how many are in Connecticut and how many aren't. And they also count somebody to whom income is required to be distributed, except for Q-tip trusts. It doesn't happen all that often, or anybody with the power to with a general power of appointment, and that doesn't come up all that often either. California is important because it's got like 40 million people. It's got an eighth of the country's population is in California. I'm on the East Coast. I'm admitted near New Jersey and Florida, so I don't deal with California that often, but we do have people in the entertainment world who are bi-coastal, and sometimes they're better off being California residents because New York has a state-to-state tax and California does not. And until very, very recently, in New York, you didn't have a right to your name and likeness after your death, and your right to publicity. Much better in California. The Marilyn Monroe estate was litigated for decades as to whether she was New York or California. Anyway, California taxes a trust based upon the residence of the trustees and the residence of the non-contingent beneficiaries. Well, except for the spouse and a Q-tip trust, you'll almost never have a non-contingent beneficiary, because the definition of a non-contingent beneficiary is what they say, one whose interest is not subject to a condition precedent. That means you've got an entitlement, and normally you have discretionary interests. So it's the trustees that are going to be the key. So a non-contingent, if you're a discretionary beneficiary, that doesn't count until there's a distribution, and at that point, the beneficiary is going to be taxable. Since California will tax you merely by having a trustee in California, they'll give you a credit for the other state's tax on the same income. So let's say you've got a New York person creates a trust and there's two trustees, one in New York and one in California. So New York taxes all the income, California taxes half the income. In California, it works like a foreign tax credit. They'll give you a credit for the proportionate share of the they'll give you a credit for the New York tax on the same income up to a proportionate share of the California tax. The way a foreign tax credit would work, or the way state income tax credits work for people who live in one state and work in another state. So in that example, they could have avoided the taxes in both states just by having a trustee in some other state. You could have a corporate trustee in Delaware, South Dakota, or Nevada, or even a human being trustee in New Jersey. People who live in New York probably know somebody who lives in New Jersey or Connecticut, because the states are pretty close together. It's not like California where you got to go hundreds and hundreds of miles to get from. It's about 900 miles from the top of California to the bottom of California, and in Texas it's probably at least that far from one end to the other. The good thing about Texas, at least from the state income tax standpoint, is they don't have a state income tax, whereas New York and California do. California has a throwback rule that is much, much broader than New York. Basically, whatever is accumulated in one year and distributed to a California resident in a later year is taxable. Again, the beneficiary gets a credit for the tax the trust paid to other states. So people that have dealings with, that have connections, where there are connections to high tax states like New York and New Jersey, and California and New Jersey goes up over 10%. I forgot about that. It goes up to 10.75 above $1 million. And these days, it seems lots of people have income over $1 million. Pennsylvania and Illinois are interesting because their definition of a resident trust is the same as New York and New Jersey. They look to who created the trust. There is case law that says that they won't be taxed if there's no trustee in the state, no real or tangible property in the state, and no income from sources in the state. But those cases only deal with trusts created during lifetime. We do not know how they will look at trusts created by will. New York and New Jersey look at them the very same way as they do trusts created by during lifetime. Connecticut, however, does not. Connecticut taxes trusts created by will. They say that there's enough of a connection to that state because matters involving that trust would be heard in the courts in that state because there's a continuing jurisdiction. There are some states where testamentary trust, there is no continuing jurisdiction. Florida, which of course has no state income tax, but in Florida, the courts don't even give out letters of trusteeship to the trustees of trusts under a will. Go explain that when you open up an account in a bank or a broker outside of Florida, why you don't have a court certificate, but that's how it is. A couple of other quirky ones. Colorado taxes a trust if it's administered in Colorado. So if you have one trustee in Colorado and one trustee in some other state, you could have the trustee in the other state take the lead role in the administration. The statute doesn't define what administered in Colorado means, but we assume it means the preponderance of the administration. We had one once where we had a grantor in Arizona, which looks to whether there's a trustee in Arizona. And we had a trustee in Colorado and a trustee in New York, and we had the New York trustee take the lead role in administering the trust. And we had our trust taxed nowhere, which was really, really wonderful because we had one year where we had about $8 million of income in the trust that year. I think it was 2012, the last year that qualified dividends and long-term capital gains were at 15 rather than at 23.8. And we had a holding company, and it had huge accumulated earnings and profits, and we just paid out the earnings and profits so we could make an S election going forward. The key person had died, and the next generation really wanted to go their separate ways to the extent they did. So they were able to keep it in the trust in the year in which they got the income, have it pay federal only, and then make a distribution to the beneficiaries in the next year. I guess that wouldn't work for any beneficiaries in Colorado because of the throwback rule, but it would in the other states. Idaho, I mentioned Idaho because everybody asks whether the governing law determines where a trust is taxable. Gee, if it did that, I would have every trust say it's governed by the law of Florida or Texas or something. Some people even ask whether I can say in the trust where it's taxable. Well, yeah, then I would say in every trust that the trust will be subject to state income tax only in Florida or Texas or something like that, but it doesn't work that way. But in Idaho, there are 5 factors, and if 3 tests are met, you're taxable in Idaho. So one is the domicile or residency of the grantor is in Idaho. Well, that you can't change. That's easy. One is, do you have real or tangible property in Idaho? That's pretty easy. Is the trust governed by Idaho law? Well, gee, if you've got a nexus to another state, you can pick that other state as the governing law, since the other states won't tax you merely because it's governed by their state's law. So if you have a grantor or a trustee in another state, you can use that other state's governing law. The domicile or residence of the trustee is in Idaho, and the administration of the trust is in Idaho. So if you're going to be 2 and 2 and the other 4 have the trust governed by some other law, and the real point of this isn't the Idaho law. I've never had any Idaho trusts. I've never had any Idaho trustees. It just means that whenever you have a trust or whenever you are creating a trust, you should check the laws of every state to which the trust has a connection. Where is your grantor? Where are your trustees? Where is the assets if it's real estate? So what are your planning opportunities? Consider your choice of trustees. A lot of the banks and trust companies have affiliates in different states. If a testamentary trust would be taxable, where an inter vivos trust would be exempt. If the tax is enough, the Pennsylvania rate's only about 3%. It may not be worth the effort. The Connecticut rate keeps going up. Maybe you can decant the trust. Incomplete gift trusts we'll talk about a little bit later. And revocable trusts could save or cost state income tax after death. An incomplete gift trust is a trust that is not a completed gift and is still in your estate, but it's a separate taxpayer for state income tax purposes. So I did an article on that in the September 2005 issue of Trusts and Estates, which if you just Google Bruce Steiner, Kleinberg, Kaplan, it'll pull up my bio, and the articles are there, and they're in order by date, newest on top. So I live in New Jersey. I create a trust in, let's say, Alaska or Delaware, or Nevada, or South Dakota, and it can be not a completed gift, still in my estate, but its own taxpayer for state income tax purposes. Wonderful if I've got a large one-time capital gain, or maybe if I've got a big investment portfolio. New York people can no longer do it. They must have read my article and people started doing it, but people in the other high tax states can. So we do this for people in say, New Jersey or we even do it for California. Revocable trusts are interesting. I know they're common in some states like California. They're not common in some states like New York. They're almost never done in New Jersey. But they have a state income tax consequence, because an estate is a resident estate in your home state, but different states have different ways of determining when a trust is taxable. So if you want trust status, let's say you're in a high income tax state and your trustees and your assets are going to be outside the state, if you do a revocable trust or even a decant of a testamentary trust, you can avoid state income tax. Be real careful not to make a 645 election, because that would make you become an estate for income tax. And a simpler solution may be just to distribute your income on a current basis, and that will throw out the income. So really, the takeaway from all this should be that whenever you're creating a trust, you should consider what state or states your trust is going to be taxable, and if there's an easy way to have your trust not be taxable in any state, you should try to take advantage of it. This will be even more important going forward because it became more important when the limit on the state and local and the deduction of state and local taxes took effect in 2018, and that's scheduled to revert in 2026. There's proposals pending in Congress. No one knows what will happen. There are also proposals pending in Congress in the Ways and Means Committee's bill, which would basically eliminate the use of grantor trusts. It would say that a grantor trust created after enactment would be included in your estate, which means that you would rarely want to create a grantor trust. And that means the trusts you create will be their own taxpayers, which means you have to consider the state income tax if your trusts invest mainly for qualified dividends and long-term capital gain and tax-exempt income, which is taxable at 23.8. Federal may go up, may not go up. So if you're taxed at the state level at 0 rather than at 9 or 10 or 13 or 14, that makes a huge difference in your total tax burden. It was even bigger difference in as late as 2012, when the federal only went up to 15 rather than 23.8. But at that point, the states were a bit lower. New York and New Jersey have gone up since then, and I don't remember whether California pushed it up to 13.3 before then or after then. And there's even been some discussion in California to push it up even some more. So you really need to pay attention to this, both in the planning and in the administration, to make sure that you're paying tax where you owe tax, you're not paying tax where you don't owe tax. If you paid tax where you don't owe tax, claim refunds for the open years, and then consider whether you can't consider whether you can change trustees to avoid being subject to a high tax state or things like that. Again, you can find my article on the incomplete gift trust, as well as many of my other articles. If you just Google Bruce Steiner, Kleinberg, Kaplan, my bio should come to the very top of your hits. And I see we are just about at 9 o'clock. So Jonathan, I'll turn it back over to you. But if anybody, given that we only had a half hour, we didn't really have time to take questions. So if people have questions that can be responded to in short answers rather than long answers, feel free to email them to me at bsteiner@kkwc.com. Thank you again, Jonathan.